Okay, I think we can begin. At the beginning, apologies to our internet viewers for the delay. We had some bottleneck here at the reception at our offices. Ladies and gentlemen, welcome. It's very nice to welcome you here at our offices in Warsaw. Good morning. Thank you very much for taking the time to join us for the presentation of Q3 results that will be followed with Q&A session. As usual, we are sitting here in Warsaw at the offices in front of our analysts, sell-side analysts and investors covering PGE. Please let me introduce to the speakers today, Mr. Marek Woszczyk, President of the Board and CEO, and Ms. Magdalena Bartoś, CFO. My name is Jakub Freilich, I'm Head of Investor Relations. Our speakers today will give the presentation and will be ready to answer your question afterwards. And that's for the beginning. I'll hand over to Mr. President. The floor is yours.
Thank you very much. Good morning, ladies and gentlemen. As always, as every quarter, the men of three are sitting in front of you, trying to sell something on how we performed last quarter. So it's, as always, it's nice to have you all in here at our offices. Today, we are to present you our financial and operating results of the third quarter of this year. As regular we do, firstly I will give you key takeaways of the quarter and update with the investment plan that we are running. And then I will pass the floor to Magda, who will take you through the detailed financial and operational information. Results presentation will be followed also, as always, by our outlook for coming quarters and some additional comments in regard to the regulatory framework currently discussed. Of course, at the end of the presentation will be available for your questions. So let me start with the highlights of the quarter three. This has been already published, but just to emphasize some more concrete, the most important numbers. We believe that the quarterly report that PGE has just published confirms our good standing of the company. I may say that the strong cash generation and reliable, predictable dividend policy is our trademark. At least we strive hard to do so. So our financial results, EBITDA reached 1.7 billion. Recurring number is 1.5 billion. Recurring, I mean without long-term contracts. Net profit this quarter was impacted by some one-offs in our financial activities. But anyway, the strong cash generation is our strong side. However, it is partially related to long-term contracts clearing. Dividend. PGE paid out dividend of 1.1 zloty per share at the end of September. So dividend was in line with the management proposal and represented 50% of the consolidated net profit. That translated into over 5% yield, which placed PGE, we believe, among the generous utilities in Europe. This is our long-term policy, as I said, to keep it that way. In terms of environmental regulations, recent weeks were very dynamic from the regulatory framework angle. You know about that, especially a lot has been said after the last European Council summit. I will have some more comments in the outlook session of the presentation. However, what is worth stressing, I believe, in this moment, that the 40% reduction target that was agreed during the European Council was offset by three most important solutions for Poland and energy sector specifically. I mean, special derogation for the Polish energy sector was given. in the form of so-called free carbon allowances. Second, a new reserve for modernization of the sector was created. This is a new invention. And thirdly, additional allowances were granted to the so-called low-income countries, including Poland, which are to be targeted at the energy sector investment. With regards to our operations are in line with our estimates. Net generation amounted to almost 14 terawatt hours, which is a result of the commissioning we made last year in our fleet and the modernization that we are currently running, mostly on a lignite assets. Distribution volume was at a little bit over 8 terawatt hours, which represents 3% of increase year on year. The same, more or less the same, we may say, on our sales to end users. The volume reached almost 10 terawatt hours, but there is also an increase of 3% counting year on year. The macroeconomic environment that we run our business, we believe is pretty comfortable. So the economy is performing relatively well. GDP growth is over 3% after nine months, so we see significant improvement when compared to last year, for example. Domestic electricity consumption is growing as well. This is an important factor from our perspective. After the first half of this year, we were questioned about the forecast of the electricity consumption. Then we said that our forecast is that slightly, but still the consumption of the electricity will grow, and indeed it is slightly growing. So the dynamic is especially visible in the last quarter. Throughout the year, the growth was at 0.3%. Price development, another very important factor from our perspective on a wholesale level. So price development of the last quarter shows the dynamic changes on the commodities market, namely hard coal, but also carbon allowances prices. However, the latter ones are moving within the corridor between 5 and 7 euro per ton of CO2. So this year's prices were impacted additionally with the regulatory changes that we described widely at the beginning of this year. We call them capacity payment, but to be more precise, operational capacity reserve and so-called cold reserve. This is it performs according to its assumptions, and of course it has an impact on the wholesale prices. So the outlook incorporates also the demand-supply situation in the system, no doubt about it. Our investment. We are on track with our flagship investment projects. I mean, Opole, second, units 5 and 6. So step by step, further milestones are being realized. Recently, works on construction of cooling tower and drainage of units started. We spent almost a quarter of a billion zlotys so far for that project. Important information from Turów project. We already notified our general contractor that the notice to proceed will be issued on December 1st. So this is a result of the positive court verdict that rejected appeal of one of the bidders. General contractor has 56 months after issuing NTP for construction. So the third flagship project of our conventional capacity investment we can consider today as finally initiated. We continue procurement with the renewables portfolio. In the third quarter, we signed contracts for 2 wind farms. Their name is done by location, so I mean Lotnisko and Resko 2. Lotnisko has installed capacity of 90 megawatts, and the total bill, including engineering and turbines, should be at the level of almost 500 million zlotys. As regards to Resco, this is the wind farm of installed capacity of 76 megawatts. The contracts amount to almost 350 million, so both farms are expected to be commissioned by the end of the next year. So at the end of 2015 we should have them operational. Of course, last but definitely not least, PGE finalized construction of the new cogeneration gas-fired unit in Rzeszów. It took place in October, just before the heating season. The construction of this unit, first of the kind in Poland actually, took 15 months and was according to the schedule. It costed us over 100 million zlotys. What is important, the newly commissioned unit will be sufficient to meet electricity needs of the large part of Rzeszów and allow us to reduce the coal firing and carbon emissions. I emphasize the reduction of the carbon emissions. And that's it from my side. So the floor is yours. Yeah, go.
Thank you, Mark. Hello, everyone. It's also my pleasure to see you all here at our premises and hopefully to see the also known faces through our webcast. As with previous presentations, I'll provide you with an overview of financial and operational details, followed with some CapEx summary and outlook for our next quarters. PGE's business performed as we anticipated and guided you on in our last presentations. Our last quarter EBITDA was 1.7 billion, down by close to 400 million, with similar performance delivered on a recurring basis. 9 months EBITDA is flat to last year's comparable. Net profit of the quarter change was driven predominantly with the operational result change, but also to a large extent impacted with financial assets write-off as we performed impairment reviews of our asset base this year. Our 9-month underlying income is 2.9 billion Polish zloty, down by 400 million versus last year. Our operating cash flow was substantially higher than last year and contributed 2.9 billion, as the decline in our earnings was more than offset by positive working capital effects, in particular received long-term contract compensation payments of 1.2 billion Polish zloty. Our 9-month investment were roughly 40% above prior year figure, as we continue to deliver against our strategy plan. Despite growing investment outflows and substantial dividend payments in Q3, our net cash position remains solid, and we closed the quarter with more than 1 billion of cash on our accounts. Electricity generated by the group amounted to close to 14 terawatt-hours, down by 5%. The decline in production volumes is a result of our conventional generation units portfolio management as we continue refurbishment and modernization of our largest fleet in Bełchatów. 2 units were down for works this quarter. As we mentioned in our previous presentations, one of our Turów unit was down and decommissioned last year. Our hard coal-fired fleet in Opole plant was also undergoing major overhauls, producing to close to half terawatt-hour less output, and similarly to last quarter's, electricity volumes produced on hard coal remain lower as one of our Dolna Odra unit was decommissioned last year. With each new quarter, our renewables assets deliver more electricity output. In Q3, that was up by 20%, as we seize opportunities on biomass co-combustion and add on capacity on wind generation, on installed wind generation. Thermal generation production volumes in Q3 were, as we mentioned, largely affected by the availability of our assets, mainly within the Opole plant. CHP's and wind asset performance was solid, and both availability and load factors were outperforming the last year metrics. Our distribution teams consistently deliver against the strategic priority of being a reliable supplier, keeping network losses at low, and considerably improving on interruption metrics. I will now turn to more details on our last quarter's main earning drivers. A reduction in utilization of our conventional generation fleet and further decline in wholesale prices hit our numbers most by close to 300 million Polish zloty. Q3 was another quarter of 2014 with lower average realized prices of electricity. This time that was down by 7%. It is worth noting, though, that last year's third quarter was at the lowest with regards to base contracted prices. As majority of our lower production volumes on electricity relates to hard coal generation, the drop in electricity outputs also, is partially offset with lower fuel usage, and hard coal volumes provide for less of cost. As we go through 2014 results, retail margins continue to adversely affect our numbers and our supply business profitability. That is consistent to our comments in last quarter's presentations and also with outlooks published. Cogeneration support was another burden to our operating results. As we are only kicking off the heating season, we were not able to offset additional retail costs with produced certificates. With growing green certificates production at our renewables fleet, we more than offset growing redemption requirements, providing a positive comparable to last year's quarter. Our conventional generation business delivered close to 50% of our recurring earnings. EBITDA of the segment is down by 20% due to already mentioned lower electricity prices and lower production outputs. Earnings at distribution business were flat and constitute 40% of the group results. Increasing value of regulated asset base and efficiency improvements allowed us to largely support the drop of 2014 remuneration of assets reflected in the tariffs, a decline in weighted average cost of capital. The main adverse factors to group's earnings remain retail margins, that is here allocated to wholesales and supply business results. Renewables business keeps to increase their share in the group results, growing by 5% as we grow our asset base. Our Q3 investments of more than 1.6 billion Polish zloty were substantially higher than prior year figure and almost half of the year-to-date investments. The main focus, about $500 million invested, was in Bełchatów plant, with roughly 430 million invested in modernizations there. Out of the growth conventional generation capex, majority was spent on Opole 2 project. Renewables investments progress as planned, and 68% out of the 87 total was invested in our Karwice wind farm. Following our half-year results presentation, we provide you some more details on organization streamlining of PGE Group. In Q3, we established a tax group, which also accelerated flattering of our organizational structure. Currently, all of our key subsidiaries are direct holdings of PGE SA, and that will not only allow us to benefit from synergies on income taxes, but also allow to simplify and shorten decision-making process and communication. As we are close to 2014 year-end, we decided to take a more distant look and more distant perspective with our earnings and investment outlook. During 2014, we've been observing stable growth in contract prices for electricity. Year-to-date prices increase amounts to 8 to 10 Polish zloty per megawatt hour. That allows us to expect that electricity prices will drive our operations and our generation business results up. We continue to work on efficiency improvements. in all of our business lines, and that will also support our results, in particular on conventional generation and distribution business lines. Cost of money remains key uncertainty. Further decline in discount rates may lead to increase in our land restoration and long-term employment benefit obligations. With supply business, our key focus will be on introduction of the new trading model and enhancing margins. Renewables projects are on track, and if delivered on plan, will be commissioned only late 2015, thus not impacting the operating results of the renewables business line. We remain committed to our strategy plan and will outlay significant cash flows on our flagship projects in Opole, Turów and Gorzów, accompanied with modernizations of Bełchatów and Turów plants. Thus, we expect the CapEx to grow substantially next year as well. With that, I will finish and hand over to Marek to give us some more outlook on the regulatory framework.
PGE is running its business in a world full of the regulations. So let me start with the renewables law. As we are hearing from the Parliament is working very hard on new law, and it is expected that the law to be passed by the end of this year. Which is in general in line with our expectations, which were behind our investment decisions in the renewable sector. But my personal impression is that, I'm observing that process of the draft of the new renewables law since a very long time, and however, I see that there is some acceleration of the work on it, and indeed there is a political consensus. This is my estimation. I emphasize that political consensus on soon delivery of that project and forming into a final law, binding law. I will not be surprised if the process will take a little bit longer than it seems to be today. But anyway, as I said, this is in general in line with our expectations in terms of the, let me call it, treatment of our renewables portfolio. As for now, there has not been major changes in terms of the merit, in terms of the content, in terms of the provisions drafted in that new Renewables Law Act. So still the system is to be based on a 50-year support. Already working installations should receive certificate support, while new ones will compete in the auctions. By the way, the auctioning, which is to be placed in the hands of the Energy Regulatory Office, might be a critical element of this whole concept, I believe, because it needs a staff, it needs the proper administration, proper resources to manage the whole auctioning process, and this might be, let's say, a kind of a bottleneck, referring to the situation that we had before our meeting. It might be a kind of a bottleneck in the whole process. But anyway, current agenda includes that the first auction should take place already in the mid of 2016, and the winners of the auctions will have a 4-year contract for delivery of the volume. So this is nothing new for us. Still, distribution network operator will have an obligation to dispatch electricity from the producer, from the green producer. However, the guaranteed price will be based probably on the quarterly average, as this proposed at the recent version of the Law Act. This is just to smooth, I think, the volatility of the market. Some utilities might be, actually are, more impacted by the existing provisions when not quarterly but yearly average is taken into consideration when clearing the delivery of the production from the renewables to the so-called supplier ex officio. The second point I'd like to take to draw your attention is the capacity markets. Long-awaiting consultation process that took place so far within the sector is over, and the conclusions were passed to the Ministry of the Economy. So the energy sector recommendations aim at centralized capacity market approach, more or less the same approach as recently UK has adopted. I mean, this is a capacity market that is to be operated and managed principally by the transmission system operator. But the whole concept of the so-called capacity market includes also the contracts for difference as a special vehicle, special facility drafted to the nuclear power plants and offshore wind farms, potentially, of course. So we believe that as an energy sector, we believe that the solution is comprehensive and a cost-effective reply to the needs of the network, to the needs of the transmission system operator. And it should be, in our opinion, in line with the already approved mechanism by the European Commission for the UK market, as I mentioned. But we will see. This is the first phase. Then we pass the floor to the Ministry of the Economy. Probably the whole concept, the whole paper will need to be supplemented by additional proposals. I mean, basically the concrete draft provisions that should transfer the whole concept into the real legal life. Because no doubt the whole concept has to be presented to the European Commission for the notification. But anyway, we expect, and I believe that I have a sound reason to expect, that the current so-called interim solution, I mean operational capacity reserve and so-called cold reserve, will remain in place until the capacity market in its final form will be delivered, will be binding solution. I'd like to give you also a quick update on what's new in the distribution business, of course from the regulation angle. We know that the next year tariff is to be based on a weighted average cost of a capital at the level of 7.2%. This is the information that has been disclosed already by the regulator to us. There is a still ongoing discussion on the new model of the regulation, so-called quality-based regulation or incentive-based regulation. So we may expect some more clarification on that in the following year. As I said, the discussion still continues, but we expect that the quality component within the whole new model will be based in the first year of the new regulatory period on the three main factors. I mean, SAIDI and SAIFI, interruption factors, and connection time to the new customers. And I'm personally happy to say that because this is also a component, obviously, of our strategy as it was published in May of this year. The general assumption, as we know from the regulatory office, is that the new model shouldn't increase the regulated revenue of the distribution networks. This is also not a surprise for us, but it means to us that this is the right way that we chose to let's say, increase our operational efficiency and to reduce the costs of our different business lines, including the distribution. Another important element of the drafted new regulation model in relation to the distribution business is that the distribution companies will be assessed on individual targets, given the natural differences of the operators' grids. And this is good news from my perspective. It's definitely the PGE distribution grid is not the same as, for example, the RWE Warsaw grid. The last, but from my perspective, definitely not least issue that I'd like to mention is so-called BREF, or Best Available Techniques Regulation. We have a IPPC directive, Integrated Pollution and Prevention Control Directive, that require very strong effort from the utility sector to reduce, different from CO2. The CO2 is the most fashionable issue, most discussable, mostly discussed issue recently, but the CO2 is not the only pollutant that we are obliged to reduce. There are others like sulfur, like nitrogen oxides and dust emissions. And about all this stuff, this is IPPC directive that is dealing with in the form of so-called best available technique references. And the Commission is planning to issue the new revised BAT. And we know as a whole sector, and I'm not saying only in the name of the Polish sector, but also in the name of the German sector, in the name of the Czech utility sector, we have more or less the same position on that issue. That if adopted, the new regulations will have a strong impact on our investments, on our costs, on our spendings, basically. So we are lobbying hardly for such a regulation that would qualify the new investments to be potentially exempted from the old investment, the operating units to be exempted from the new regulations. In other words, the new regulations, more restrictive ones, should apply only to the new investments. And finally, when it comes to the conclusions from the European Council on the climate issues, of course, 40% target of the reduction of the greenhouse gas emissions was established. This target is binding on the EU level. There are no binding targets for each particular countries. However, we may expect that each country, each member state, will have to present some plan, some action plan, to commit to the European binding level. But as I said at the beginning, there are three most important issues that were decided to offset the reduction target's introduction. Firstly, derogation period for countries below 60% of the GDP per capita European average. Actually, Poland is within the threshold, as the calculation relies on the market prices from 2013. So this derogation will allow to allocate up to 40% of auctioned allowances directly to the energy sector. The number available for Poland may reach, according to our estimates, up to 280 million of tons of the CO2 in total. Of course, today we don't know the details on how this, let's say, free allocation, free allowances are to be allocated to the Polish sector and to each particular utility. But anyway, we may expect that we will, we will have a part of that free portfolio. Let me call it like that. So, secondly, energy sector can benefit also from the newly established modernization reserve. Auctioned allowances will be available for the funding special technical upgrades in the sector. So given the share in the emissions and the GDP, Poland may receive approximately half of the fund from this reserve. So we may estimate it at a level of 135 million. Still don't have too many details on how this will work. But anyway, it's better to have such a fund than not have it. And thirdly, 10% of the total ETS allowances for countries with GDP per capita below 90 European average, Poland's is included, will be transferred as the budget proceeds and its use, if intended, at set needs. So we estimate that Poland may have around 270 million of the carbon credits. So anyway, our judgment is positive on what our government has brought from the Brussels after the last European Council. I had already a chance to say it in Opole, that in our estimations, in our calculations of the economic profitability of, for example, Opole, we did not take into account possibility of having the free allowances of the CO2. So definitely, from our perspective, and the, let's say, economic profitability of that project, this is let's say, good news. This is an improvement in terms of the expected rate of return. So that's it. That's our judgment. However, of course, I have to emphasize that the more details should be elaborated, and this is still unknown area. I think that the government, together with the utility, with the energy sector, because as an energy sector, as the utilities, we already started our works to present, to give to the government our proposals on how we see the distribution of that achievements that government has achieved at Brussels. But I think this is a question of the coming months, that these issues are to be discussed with the European Commission. So that's it from my side. Thank you very much for your attention. So this is the time for your questions and our answers, I believe.
Thank you very much. Well, we give the floor to our audience here in Warsaw first. Just for the sake of clarity of the discussion, to allow us to answer questions in more convenient way, please ask no more than 2 questions. Obviously, follow-ups are very welcome. I'll give the floor to you, then we'll give the floor to our internet viewers. The questions are coming online. So, please go ahead. The floor is yours.
Few questions. Several days ago, one of companies from the sector announced cut in its capex, in distribution capex. You've got your official guidance for mid-long-term capex. Do you plan any cuts to your mid-long-term distribution capex?
Our strategic assumption allocates 12.3 billion, if I'm not mistaken, to distribution capex. That amount was much largely agreed with the President of the Regulatory Office in the recently approved development plan of our distribution grid, and we keep stick to that.
What was the intention of the question? Because I'm interested. What is the intention? Your question is whether we will exceed our capex or will maintain, we keep below.
It's very simple. Energa suggested that the costs have fallen, and reduction in capex comes pretty natural. That's why I'm testing one company after another, whether costs in other companies also are on the decline or maybe not.
There is a project in our distribution business line, and we expect that this project should deliver also the optimization costs, because the project is concentrated on how to optimize our investment policy. So the capex is a different story. That's why I asked the additional question, because I didn't catch the essence of your question. Okay. In terms of the optimization of the whole process, including the investment planning and investment spendings, yes, we have a special project dedicated on that, and the project is becoming to deliver. In terms of the capex, it should also, in a consequence, deliver in terms of the OPEX. We know that. We know that. This might not be yet visible on our distribution business line. I'm not hiding that, but we promise to deliver it.
On page 16, in distribution section, you mention quality factors, SAIDI, SAIFI, connection time. In your opinion, in your view, you think those bonuses based on SAIDI, SAIFI and connection time would be calculated as a percentage of regulatory asset base or as a percentage of distribution revenue?
Of course, this is a better question to the regulator. But my opinion is that the quality factor will be applied to the WACC, not to the component of RAB. But as I said, discussion continues, and it is too premature to declare anything on it, because the last word belongs to the regulator. However, we are in a good dialogue with the regulator on that. That's why I'm saying what I'm saying. This is not, you shouldn't read me that, it should be like that, because the dialogue is not only between the PGE and the regulator, but between the regulator and any other DSO, any other Polish DSO. But we are glad, the regulator will concentrate on the so-called low-hanging fruits and the first regulatory period of the new quality model. What might be the low-hanging fruits? This is, of course, interruptions. These are interruptions, time of interruptions, expressed in the form of SAIDI and SAIFI factors, and connection time, obviously. And I think that the methodology that is being discussed with the regulator will apply more on WACC, but slightly. We are not threatened. We don't expect any major surprise that suddenly the regulator office will take us aback somehow and reducing our 7.2% of WACC, for example, to 7.0. No, I don't expect such a reduction. It should be rather a testing period on how the new quality model should or can work. Okay. But I'm not sure if the regulator intention is to still proceed with the bonus-malus approach, or maybe only with malus approach. Some things tell me that the regulator will proceed only with a malus approach. So there will be some standard performance, and if you if the DSO does not reach the standard performance, that is below, then probably the malus will be applied to the work. But this is the philosophy that the regulator presents in ongoing discussion today. But we still have at least half of a year to finalize that discussion.
The first question is about the potential for the further actuarial reserves in the Q4. As I remember, currently the rate is like 3.5. On the market, it's way above, below 3 for now. So again, what are the possibilities for the actuarial reserves in fourth quarter?
Our long-term obligations, not only actuarial reserves, but also land restoration reserves, are valued each half year. The last valuation was performed as of end of June, and as you mentioned, the discount rate applied was 3.5%. We obviously observe the movements in 10 years treasury bills. That is the base component for our discount rate computation, and we will be applying changes as of end of year. We are also discussing with the auditor, in particular, to land restoration what the proper discount rate applied should be, as the perspective is much longer than the one for the actuary reserves. But to conclude my answer, the next valuation will be as of end of year, and should reflect any other change in the 10 years treasury bills.
Thanks. Can you elaborate some more on this bond impairment?
PGE holds bonds of AFSA, which is an infrastructure holding, and as the investment has got negative equity, we decided to write off in the impairment review this year. If we have any justifiable evidence that the investment is able to pay off the bonds, we will be then reversing the impairment review, the impairment provision. As of now, we do not have any of such justifiable evidence.
What we saw was improvement of some of the EBITDA of wholesale and sales segments. It was a quarter with the full certification, all 3 months. So were there any steps, particular steps for the improvement of the EBITDA? And I guess we all expect the strategy, according to the segment, how to improve the margins, and what about the profitability?
If I may clarify your question, you are asking about prospects for retail margin improvements as a result of our new trading scheme.
Yeah, and what about this trading?
Excuse
me. What are the changes to the segment strategy to improve the EBITDA?
I think that you may see that the market is split between generally speaking, two different retail strategies. I mean the margin strategy and the volume strategy. PGE, no doubt, has adopted 2 years ago rather volume strategy than the margin strategy. And PGE has invested some money to realize that strategy. According to the adjusted strategy that we published in May, our intention, I mean the management board intention, is to change that strategy into a more balanced one. But we are aware that we invested some money to build a higher volume of the retail customers than we had before, and we don't want to give it up, which means that yes, in the future, and this is the principal assumption of our project to deliver the new updated trading strategy, is to concentrate more on the margin, less than on volume. But it does not mean that we will give up with the volume already reached.
Thanks. Can you comment on new reserve margin remuneration scheme for 2015?
What's the tech operation? Okay. There's a proposal from the transmission system operator to change the rules how the operational capacity reserve is remunerated, in order, I think, to make it more efficient, more cost efficient. But I believe that the budget allocated for the operational capacity reserve in the new TSO tariff for the coming year is to be higher than the budget allocated in that tariff, in the present tariff. But I cannot say for the regulator how huge or what the percentage this budget should be higher. But you have to remember that the operational capacity reserve was an interim solution, and I mentioned that when I was telling about the capacity market, full-scale capacity market model. The first year, we're almost after the first year of the existence of that ORM, and this was the first year of experience, from both perspectives, from TSO perspective, from the regulator perspective, and from the utilities perspective. What TSO has proposed 2 or 3 months ago to reduce the fee for capacity. Okay, this was the proposal of the TSO. So far not approved, and I don't expect that the regulator will approve that change. Shows that everybody is trying to take the good experience to learn the lessons on how this mechanism works. And I read the latest proposal from the TSO, I mean the latest proposal that concentrates not on the budget itself, but on methodology, how the capacity reserve is to be remunerated by the TSO as a very complicated mechanism, but anyway is aiming at optimization of the budget allocation to the different utilities across the market, delivering the capacity reserve to the TSO and profiting from the budget allocated by the regulators to the TSO tariff. So, in briefly, making a long story short, I estimate, this is my forecast, that the budget for the coming year allocated to the tariff will be higher than the budget allocated in the present tariff of the TSO. But I cannot say about anything about the relation to the new budget to the executed budget, because we know that the TSO has exceeded the budget allocated by the regulator in the existing tariff.
So maybe
For clarification here, do you expect any change to the maximum level of the fee paid to the power plants? It is 37 Polish zloty for now. Are there any changes expected?
But 37, the effective price, so realized price, is lower than 37, something like 35.
yeah, but the maximum level.
The maximum level it may change. Depends on the final budget, let's say.
Thanks.
I will Get some questions from the internet viewer. Number of questions. There's a number of viewers that are asking questions for clarification. If the bond impairment we had will have an impact on our dividend policy, is that going to change the consolidated net profit into cash flow, or will that impact the dividend?
Dividend payment policy relies on dividend payout, and we are constantly confirming that we intend to pay 40 to 50% of net consolidated earnings to our shareholders. We also confirm that today, following the net underlying income of 2014, we will be proposing the dividends payout for next year.
Can go back to Drew.
I just wanted to continue the question about ORM mechanism. And in your opinion, how would this affect the prices, electricity prices in 2015?
Well, they're making them higher, basically.
Compared to this year?
I believe so. I believe so because they're compared. Of course, this is the market that establishes the price. It's a difficult question, but generally speaking, the ORM mechanism was meant to set up a higher prices on the wholesale level, not on the retail level. This is a different story. And as I said, it worked and it works according to its principal assumption. Today, judging the situation, but trying to forecast what may happen on the wholesale level in terms of the prices in the coming year, I have to look what is happening with the, let's say, most popular forward contract that we internally call the price driver. This is a base, forward base contract for the whole year 2015, for example. Yeah? And this is higher. So this is bought and sold at the higher level that was bought and sold a couple of months ago. Of course, this is a moderate, very slow growth, but we expected that this growth is to be rather moderate, not a huge dynamic. We didn't expect a huge dynamic in terms of the prices evolution, but rather small, moderate growth. And this is important from our perspective. So I believe that in terms of ORM, the most critical fact is that ORM should be in place until the final concept of the capacity market is to be delivered by the government, by the parliament, whatever. Okay. Of course, the budget is important, and methodology of calculation of the remunerating price is also important. But generally speaking, the existence of the whole concept is important. So in my opinion, I wouldn't expect that the prices for the coming year are to be lower than the prices from this year. We don't assume such a scenario. But I'm not also expecting that the prices in the coming year are to be dynamically higher. There's no reason to that, actually. There's no reason to that, I think. However, we have to be aware that we're approaching closer and closer to 2016, when we may expect some decommissionings on the market, and that the market is discounting that effect. That's why we believe that the prices are slowly but still going up on a wholesale level. I'm trying to differentiate between the wholesale and the retail level because the retail level depends on the regulations, on the green, on the red certificates, on the yellow certificates, maybe orange certificates, and other types of the taxes and levies. Okay? This is a different story, despite of the fact that this is a still regulated market in one quarter. I mean, 25% of the volume is so-called G tariff, still regulated by the Energy Office. So we concentrate on the situation of wholesale level, no doubt, because there's the, let's say, pretty large contributor to our EBITDA. However, we don't ignore the retail segment. You had a questions to us on the retail segments, and that's good. That's good because we are changing our strategy.
From Citibank. I wanted to ask a little bit more questions about the bond and Autostrada Wielkopolska. Company tried to sell this stake for roughly 400 to 500 million 3 years ago. At least there was a press speculation. Can you please explain what is your estimate with regard to the valuation of this stake? What's the book value of this? Because from my perspective, if the market was aware that this stake is worth 400 million and you take 300 million impairment, in total we're talking about a serious number. And is the bond in default by now, or what's the risk for the whole, who's the other bond holders?
The bond is not in default. We are only assessing the situation of the bond issuer based on the balance sheet performance. As we see equity being negative, and as we see that consecutive, we decided that we've got, out of the prudence approach, we've got no justifiable evidence that we will be able to collect the payment. If it happens, as said, if we've got any chance of any change of the circumstances, the holding is in right now. And as we are aware, that largely depends on some court decisions as well, we will be then reversing the write-off.
And how much do you think your stake is worth in this company?
We have already written, or we already wrote off the stake in Autostrada Wielkopolska in the previous reporting periods.
Okay. And if I may ask about this 2030 targets, 40% reduction of CO2, what do you think this target means for PGE? Why do you still consider Gubin lignite deposit as a way forward, or this decision really means you going for nuclear? Because we're talking about only benefits for now, but in truth, this is pretty bad decision because CO2 will be bloody expensive.
We don't know yet anything about the prices of the CO2 in the future because anything concrete. If
we say we receive a lot of money because of free CO2, that means CO2 will be expensive. If I agree with you, it will be cheap. We got nothing.
Okay. I fully understand. But we stick to our estimations in terms of the evolution of the prices of the CO2 for the future, as we took into as we calculated our, or assessed profitability of our, flagship project. Nothing is changing in relation to the strategy that we published in May. So if you ask me about Gubin is still a strategic option. This is, option that exceeds the strategic horizon of the strategy that we published in May. But we want to stick to it. Today we are concentrating on the licensing process and, let's say, managing the local relationship with the local stakeholders around the Gubin, which is also important, the critical fact from, let's say, PR perspective, whatever. Okay, but this is still strategic option. There is no reason to give it up. Why? For example, the Bełchatów. Bełchatów lignite mine is not done forever. We know that somewhere around 2040, we will be fine with the Bełchatów lignite mine, and then we'll have to do something with our, let's say, primary energy resources. But yes, I agree that the last European Council conclusions, how to call it, give us more comfort. Thank you very much for your help. More comfort in terms of what to do about the nuclear project. Why? Because the determination, the ambitions coming from the Brussels, generally speaking, the political ambitions in terms of the climate protection, in terms of the CO2 reduction, are being kept. And probably that kind of a climate policy will continue, which not only give us more comfort in terms of the nuclear project, but also confirms that that the way that we took about investing in high efficient technologies using the hard coal, improving the existing fleet also in terms of the efficiency, especially in the lignite fleet, it confirms that this is the right way, that we should proceed. It also proves that this was a right step to capture a pretty large chunk of the market in terms of the renewable. I mean, wind farms. Okay, today the PGE is the leader in terms of the lignite, in terms of the renewables, lignite also, but in terms of the renewables, onshore renewables, not mentioning the hydro. But generally speaking, this is the right way that we have to modernize our fleet towards lower emissions, towards the higher efficiency in terms of the usage of the coal, of the fuel, etc., etc. No doubt about it. No doubt about it. But the Gubin, still, we treat it as our strategic option, seriously, as a strategic option.
Okay, thank you very much.
Okay, thank you very much. I think we will be wrapping up. If you have any follow-up questions, feel free to pass them through the management, through our team. The same applies to our internet viewers. Those questions that were not read out will be answered via email. Once again, thank you very much for watching us. Thank you very much for coming to our offices, and see you in February.
Thank you.